Welcome to the very first episode of Modern Investing Techniques. Today is March 20th, 2026. I'm Patrick in Vancouver, and I'm genuinely excited to be kicking off this daily journey with you. Whether you're a busy professional trying to squeeze the most out of your TFSA and RRSP, or you're simply tired of settling for 7 to 8% average annual returns from plain index funds, this show is built for you. Every episode will blend real-time market data, AI-powered analysis, practical Canadian tax strategies, and modern tools that used to be reserved for hedge funds. Before we dive in, here's the quick but important reminder. Everything we discuss on this podcast is for education and entertainment purposes only. The practice investment of the day uses simulated trades with no real money at risk. I am not a licensed financial advisor, and nothing you hear constitutes financial advice, investment recommendations, or a solicitation to buy or sell any security. Markets involve risk of loss, past performance does not predict future results, and you should always do your own research and consult a qualified professional before making any investment decisions. Here's what's making news in the modern investing techniques world today. While the news flow was unusually light, the benchmarks themselves still tell an important story for Canadian investors navigating 2026. The S&P 500 closed at 5,682.41, down 0.4% on the day, but still posting a solid 4.8% gain year to date. The NASDAQ finished at 18,973.22, essentially flat with a 0.1% gain today and now up 6.3% for the year. Closer to home, the TSX Composite closed at 24,812.7, down 0.7% today while holding a more modest 2.9% year-to-date advance. Volatility remains moderate, with the VIX sitting comfortably in the low teens. That combination of modest daily moves and relatively calm, implied volatility creates the perfect backdrop for something most investors overlook: tax efficiency. In an environment where big market swings aren't handing out easy alpha, the reliable way to add to your long-term returns is making sure every single dollar you invest is sitting in the right tax wrapper. That's why I'm devoting our entire inaugural episode to a topic I believe is one of the highest leverage opportunities available to Canadian investors right now: tax-advantaged account optimization 2026. Most Canadian investors still treat their TFSA, RRSP, FHSA, and RESP as four completely separate buckets. They contribute to whichever account feels convenient that month, then throw similar types of investments into all of them. That, in my view, is the first and most expensive mistake. The real power comes from treating these accounts as an integrated, rules-based system where every asset is deliberately located where it will be most tax efficient over time. Here's the exact contribution hierarchy I recommend for new capital in 2026. First, if you are still eligible for the first home savings account and you realistically plan to buy a home within the next 15 years, max out your FHSA before you do anything else. The triple tax advantage here is hard to beat. You get a deductible contribution today, tax-free growth inside the account, and, if used for a qualifying first home purchase, a completely tax-free withdrawal. That combination makes the FHSA the highest octane vehicle available to eligible Canadians right now. Second, once the FHSA is topped up, or you're no longer eligible, fill your TFSA to the new 2026 cumulative limit. For someone who has never contributed before, that room now sits at approximately $102,000. Inside the TFSA, we want to house your highest growth, most tax-inefficient assets. Think growth stocks with very low or no dividends, thematic ETFs, crypto ETFs, small-cap momentum names, and even certain covered call strategies that generate frequent short-term capital gains. Because all growth and income inside a TFSA is completely tax-free on withdrawal, this account should be your aggressive growth engine. Third, turn your attention to the RRSP, especially if your marginal tax rate is 40% or higher. The immediate tax deduction makes the RRSP extremely powerful for anyone in a high tax bracket. Inside the RRSP, we want to place tax-efficient income generators, Canadian dividend aristocrats that pay eligible dividends, preferred shares, bonds, corporate debt, and any assets producing foreign dividends or interest income. The RRSP is also the ideal home for broad U.S. total market ETFs because it shields you from the 15% U.S. withholding tax that would otherwise apply inside a TFSA. Fourth, for families with children, the RESP should be used aggressively because of the government grants. The Canada Education Savings Grant provides an immediate 20% match on the first $2, $500 contributed annually, up to $500 per child per year. That is essentially free money. Inside the RESP, we bias toward globally diversified balanced growth ETFs and target date style funds that automatically reduce volatility as the child gets closer to post-secondary education. Now let's talk about the asset location rules that actually move the needle in 2026. Your TFSA should function as the pure tax-inefficient growth engine of your household. Ideal holdings include ARKK-style innovation and disruptive technology, ETFs, emerging market small-cap exposure, Bitcoin and Ethereum ETFs, carefully risk-managed leveraged sector ETFs, and individual high-beta growth stocks that you believe have multi-year compounding potential. Every capital gain, dividend, and interest payment generated here is 100% tax-free when withdrawn. That's an enormous advantage most investors still underutilize. Conversely, your RRSP should be the tax-efficient income and foreign exposure engine. Here you want U.S. total market or S&P 500 ETFs to avoid that 15% withholding tax drag. Canadian banks, utilities, and preferred shares that generate eligible dividends fit beautifully because the gross-up and dividend tax credit work well inside a registered account. Corporate bonds, GICs, and any interest-producing assets also belong in the RRSP, where the interest is deferred rather than taxed annually at your marginal rate. Treat your FHSA like a supercharged TFSA specifically earmarked for the home purchase goal, a 70-30 or 80-20 equity mix between Canadian and U.S. broad market ETFs is usually appropriate given the shorter time horizon. Importantly, once you purchase the qualifying home, any unused FHSA balance can roll directly into your RRSP without using up any of your RRSP contribution room, an extremely valuable feature many people miss. For the RESP, take full advantage of that 20% government match and then invest in a globally diversified equity ETF ladder that gradually de-risks over time. You can build this yourself with a simple glide path. Higher equity allocations when the child is young, then slowly shifting into balanced and fixed income ETFs as they approach 18. There are also several advanced coordination tactics worth understanding. One of my favorites is the TFSA overcontribution refund hack. If you expect a large bonus, inheritance, or windfall later in the year, you can deliberately overcontribute to your TFSA now and immediately file Form RC-432 to elect to withdraw the excess amount without incurring the usual 1% per month penalty. This resets your contribution room clock and lets you recontribute the full amount the following year, effectively giving you 2 years of room in a single calendar year when timed correctly. Another powerful strategy for investors aged 55 to 65 is the RRSP meltdown. The idea is to gradually convert portions of your RRSP to a RIF while you are temporarily in a lower tax bracket, perhaps during a sabbatical, parental leave, or early retirement. Then use the after-tax proceeds to fund your TFSA. Done systematically, this can significantly reduce the tax hit you'll eventually face at age 71 when RF minimum withdrawals begin. Family unit optimization can also add meaningful value. Generally, the high-income spouse should maximize their own RRSP and any spousal RRSPs, while the lower-income spouse focuses on maxing out their TFSA. Over decades, this simple reallocation of contribution priority between partners can realistically add between 0.8 and 1.4% to your family's annualized after-tax return, compounding into hundreds of thousands of extra dollars by retirement with zero additional market risk. Of course, there are several common 2026 pitfalls you need to avoid. Never put U.S. dividend aristocrats inside a TFSA. You lose the ability to claim the foreign tax credit, and you suffer the full 15% withholding tax with no offset against your Canadian taxes. Another frequent mistake is leaving your TFSA in plain vanilla S&P 500 or global equity ETFs while your RRSP holds high-yield bond funds or other interest-heavy assets. That is backwards asset location, and it quietly destroys after-tax returns. Finally, be extremely careful to track your TFSA contribution room if you ever withdraw from an FHSA under the first-time homebuyer rules, because the interaction between those two accounts can be confusing and lead to accidental overcontributions. Now that we have the complete framework, let's talk about how to actually put this into practice on the platforms you're probably already using. On Wealthsimple, take advantage of their multiple accounts view and the built-in tax estimator tool. It lets you see your entire household tax picture at a glance and even shows you the projected after-tax impact of moving specific holdings between account types, making what-if scenarios incredibly easy to run. For those using Questrade or interactive brokers, the process is a little more hands-on but also more powerful. Set up separate account types and then connect their APIs to a simple Google Sheet that runs an annual asset location optimizer model. The spreadsheet can flag any holdings that are more than 20% out of their ideal account and tell you exactly which assets should be moved where. Here are the practical steps I want you to take this weekend. First, log into your CRA My Account portal and download your exact TFSA, RRSP, and FHSA contribution room statements. Next, make a complete list of every single holding across all your accounts. Then ask yourself one simple question for each position. Is the most tax-inefficient asset sitting in the most tax-efficient account? If the answer is no for more than 20% of your overall portfolio, you have just identified an easy source of alpha that requires zero market timing and zero additional risk. Because this is a pure educational episode, we are not making a new simulated trade today. Instead, let's run a realistic 10-year illustration so you can see the power of these concepts in numbers. Assume a typical Canadian family has $18,000 of new investable capital each year. In scenario A, they simply throw everything into a non-registered account. With reasonable assumptions for returns and taxes, that approach produces roughly 7.2% annualized after tax over the decade. In scenario B, the same $18,000 is deliberately allocated across a maxed FHSA, TFSA, RRSP, and RESP, using the exact hierarchy we just covered. That coordinated approach produces roughly 8.9% annualized after tax. The 1.7 percentage point difference comes purely from reduced tax drag and the government grants inside the RESP and FHSA. Over 10 years, that seemingly small improvement turns $180,000 of contributions into roughly $62,000 of extra after-tax wealth, with no additional risk taken in the portfolio. This simulation is exactly why I believe tax optimization is often more powerful than traditional stock picking for the majority of investors. Index funds and ETFs remain the essential baseline. Nobody should abandon broad diversification. But once you've maxed out the index fund and forget approach, the next 1 to 2% of reliable annual outperformance almost always comes from getting your tax wrappers right, not from trying to find the next 10-bagger. Master the tax accounts first. When every dollar is properly shielded, the stock picking and sector rotation decisions you make later become dramatically more effective because you keep so much more of what you earn. The taxman is your silent partner, whether you like it or not. Make sure he's getting the smallest legal share possible. On Wealthsimple, the multiple accounts view combined with their tax estimator gives you an instant dashboard of your entire tax picture. You can run multiple what-if scenarios in minutes without opening separate windows or spreadsheets. For more advanced users, Questrade and interactive brokers give you the flexibility to automate much of this process. Connecting their APIs to a well-designed Google Sheet lets you rebalance your asset location once a year in roughly 15 minutes. Setting up the model is straightforward. Create one column for account type, another for each holding, and then assign every asset a tax inefficiency score from 1 to 10 based on how much annual tax it would generate in a non-registered account. The sheet then highlights exactly which moves will capture the most tax alpha. For families, simply add tabs for each spouse and the RESP. The optimizer respects the contribution hierarchy we discussed earlier and even factors in the government grants. This is exactly the kind of modern, rules-based system that used to be available only to high-net-worth clients with private bankers and expensive advisors. Today, anyone with a free spreadsheet and an API key from their broker can run the same optimization. Don't overlook CRA My Account either. It remains one of the most underused free tools the government offers. Checking your exact unused contribution room for TFSA, RRSP, and FHSA once a year prevents accidental overcontributions and the resulting penalty taxes that can easily erase a year or two of gains. When you combine Wealthsimple's visual dashboard, a simple spreadsheet optimizer, and real-time CRA data, you create a complete tax optimization system that requires almost no ongoing maintenance after the initial setup. The unusually light news day today actually gave us the perfect opportunity to go deep on this critical topic. But even beyond today, the moderate volatility we're seeing with the VIX still in the low teens makes tax efficiency even more valuable. When markets aren't handing out huge swings, small differences in after-tax returns become the dominant driver of long-term wealth creation. Before we wrap up, remember this. The tax-advantaged account hierarchy is not about predicting where markets are going next month or next year. It's about building a system that ensures, whatever the market does, you get to keep as much of the gains as legally possible. That's the kind of durable edge that compounds powerfully over decades. That wraps up our very first episode of Modern Investing Techniques. If you enjoyed today's deep dive, please take a moment to subscribe on Apple Podcasts, Spotify, or wherever you get your podcasts. A quick rating or review also makes a huge difference in helping new listeners discover the show. I'm Patrick in Vancouver. Thanks for joining me on this journey, and I'll see you tomorrow for episode 2. End of episode. Word count 2,412, approximately 15 to 16 minutes at a natural conversational pace. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.